Oil prices have surged after Israel launched a strike on Iranian military targets, raising fears of a broader regional conflict. Joining us now with more on the market reaction is Hussein Aladina, head of commodities at TD Asset Management. Hussein, always great to get your insights, particularly in times like these.
Thanks for having me.
So let's begin with what the markets are pricing right now. We've seen the move in crude. How much is being driven by fear versus the fundamentals?
So I'd say that the bulk of the increase, and we're off of the highs that we saw overnight. We were up 13% at one point overnight. We're up 7% right now. That's all on speculation or on fear of production disruptions. Fundamentally, there's been no supply, to the best of our understanding, that's been disrupted as yet. So it's generally based on fear, Greg.
Okay, so we're in a situation right now with the market reaction. That first reaction is fear-based. How vulnerable longer term would global oil supply be if these tensions in the Middle East continue to escalate further?
Yeah, it very much depends on if production is actually impacted. If we look back, Greg, over the course of the last 15 years, any sort of price rally that we've seen has been something that historically you want to sell into. The last time we had a meaningful production disruption that was real was with the fall of Gaddafi and Libya in 2011. At that time, oil prices rallied from 90 to over $125 a barrel in a matter of months. But there you had a real production disruption where Libyan exports fell by 1.1, 1.2 million barrels a day. If we go back and look more recently, we had attacks at Abqaiq and Khurais oil refinery facilities in the Kingdom of Saudi Arabia. At that time, we saw oil prices rally from the low 60s to the low 70s, pardon me. But a week and a half later, that price premium had come out because production was not disrupted. So ultimately, the trajectory from here, Greg, is very much a function, very uncertain, but very much a function of whether production is impacted or not.
It's on the production side, obviously, very important part of the process. We also need to ship the crude. I want to talk to you about specific choke points, perhaps the Strait of Hormuz. Should we be concerned or looking at that part of the story?
It's a risk for sure. North of 20 million barrels a day of global supply traverses the straits on a daily basis. That's nearly 20% of the world's demand on a daily basis. It's meaningful. If there were to be a disruption to the straits, either Iranian induced or otherwise, we're talking about triple-digit oil, I think, without a doubt. The likelihood of a disruption there, I think, is still quite low. But again, I think part of the price action that we're seeing over the course of the last 12 hours is a potential discounting of that. We got to remember, Greg, the market has been quite bearish in its assessment of forward fundamentals for the remainder of this year. So short positioning actually in the market is pretty elevated from a historical perspective, and we're seeing a lot of that short covering take place, I think, overnight and into today.
Interesting. So explaining part of the price movement there. I want to ask you about Iran's place in terms of global oil production. How key are they to it? And if you get a prolonged disruption, if that came to pass, which you said we're not seeing just as of yet, what could that mean for global supply?
It's meaningful. Iran produces 3.3 million barrels a day. The market was expecting earlier this year that a potential deal with Iran would lend to incremental production from the country. They export 1.6 to 1.8 million barrels a day. If that production were to be disrupted, there is room for OPEC to increase production. They have spare capacity. Our view has been that spare capacity is probably not as elevated as consensus believes. But there is room for OPEC to respond. But we've got to remember that doesn't happen overnight. It takes a bit of time. It would take them, 3, 4, 5 weeks to get those barrels, I'd argue, on the water. But there is room to respond should there be a disruption. But of course, that would send prices higher because a production response would result in lower OPEC spare capacity.
So we've seen this initial reaction jump higher, you said, based on fear of what could come in the oil market. Is it hard at this point to sort of start trying to figure out where oil prices could be headed from here?
It is. I think, look, Greg, if we don't have a supply disruption, I think much of this risk premium comes out over the course of the next several days and weeks. But if we have, it's kind of binary, right? Because if we have a production disruption, we're not talking about oil at $80 a barrel. We're talking about oil at 90, 100, 110. Some folks have argued that oil could go as high as $130 a barrel, depending on the magnitude of disruption. I think, Greg, the takeaway for me here is very much that the outlook is pretty uncertain. I think the benefit of having an allocation actually in your portfolio to commodities is very pronounced right now, because you see that the impact that the strength in commodities overnight, the strength in oil is having, the negative impact it's having on risk markets. Equities were off 2% overnight. I think today are down 70, 80 basis points before I came on. I think these events just underscore the uncertain times that we're living in and the importance of having a well-diversified portfolio.
If investors do have commodities in their portfolio, they're probably thinking about gold as well. Now, not as dramatic of a jump as we saw in the price of crude, but gold prices are higher as well. How should investors be thinking about gold as a hedge in this kind of environment?
Yeah, look, I think the strength in gold is not unexpected. Gold is a safe haven, and I think that as we see increased uncertainty, you're seeing some interest flow to gold. I think the gold story is obviously bigger than what we're seeing overnight. Gold has been something of appetite to emerging market central banks who are diversifying away from the dollar. Again, I think the situation, the events overnight, just underscore what we've talked about before, and the importance of having an allocation to gold and commodities in your portfolio.